Hello, everyone. My name is barret.g.kupelian, and I am here with Andy Haldane today to record the podcast. It's the 6th of May, and we have a couple of topics on the agenda. The first one being the general financial market performance in as the Middle East crisis is sort of unfolding, and by that, we are concerned both about the debt market performance and the equity market across different sectors. And then we might unpick some of the scenarios that we could see unfolding in the Middle East and what that could mean both for the UK and for the global economy. So Andy, welcome.
Thank you. Great to be back with the next installment in the ongoing saga that is the Middle Eastern crisis, right?
Indeed. So last time, I think when we were speaking, you mentioned something about the balance sheet of UK corporates and how they should flex their balance sheet if and when appropriate to become more resilient. And one of the things I did after that conversation was I went to my laptop and I downloaded a series on the debt levels of the private sector in the UK, and particularly the non-financial corporations. I was stunned to see as a proportion of the economy, debt as a proportion of the economy for the non-financial corporate sector is at a 21st century low. So I suppose the first question I've got to you is, why is that? Why do you think is driving that?
Yeah, I mean, overall, it's a good news story. A strong balance sheet, a fortress balance sheet on the part of corporates, UK corporates, is a good thing in a very uncertain world where they may need to draw upon their reserves to insulate them from the uncertainties and the shocks that we've seen coming thick and fast over several years now. And to an extent, that pattern is mirrored among households, UK households too. I think their debt levels aren't at 21st century lows, but nonetheless are low-ish by historical standards. So that was a sense in which I began quite optimistic this year that the sort of private sector fundamentals, or these balance sheet fundamentals, looked pretty good. Now, one of the reasons I think for that, deleveraging by both corporates and households, has been for a less good reason, which is that both have been saving rather than spending. They've been running financial surpluses rather than deficits. In other words, rather than putting those balance sheets to work, they've been saving them for a rainy day. And let's be honest, we've had plenty of rainy days over the last couple of decades. So although this is in some ways the irony here, balance sheet strength is a good thing. Those balance sheets not being put to work through investment and consumption spending is a bad thing for future growth. And I'm guessing the evidence we've seen so far from surveys is that the Middle Eastern crisis caused a further desire to save rather than spend among certainly consumers and prospectively among households as well. And the flip of that is lower growth.
And would you say, is there a specific series of policy decisions that could unlock and unleash potentially higher debt levels and spending in the private sector? Or do you think it has more to do with sentiment about what's happening right now in the world?
Yeah, I mean, there ought to come a point in the deleveraging cycle where companies say, we don't need to store any more away for a rainy day. We've saved enough, and now is the time for a degree more bravery. That doesn't mean, though, that there aren't things that might be done to encourage them to put their balance sheets back to work. I was hopeful this year, I think you were as well, that one of those prompts may have been lower interest rates.
Yeah.
That now looks less likely because inflationary pressures are no longer abating, they're probably building, and therefore the markets are pricing, if anything, rate rises rather than rate cuts. So that as a prompt for putting balance sheets to work has reduced as a factor. There are still things, I think, that government could do that could nudge both households and businesses into doing a bit more. One of them actually is a degree of policy stability.
Yeah.
You know, it was good news earlier this year that the spring statement was a nothing burger in policy terms. That was a good news thing because it's one less thing for companies and households to worry about in terms of policy changes. The other bit of good news, actually, for companies is that despite all that's been thrown at financial markets and businesses in particular this year, stock prices
That's true.
have retraced all of their losses and are now trading at or close to all-time highs in a range of markets. And this feels a bit like a Groundhog Day moment. You remember last year, we almost had a rerun of this. Then it was Liberation Day that caused stocks to sink by 20, 30% in some markets and then bounced back. This year it was Iran and the Middle East that caused stocks to fall by a similar amount. But already, we're only at the start of May, we've seen those losses being clawed back. That must be a vote of confidence in businesses in the UK and internationally to some degree, which I think is in part a reflection of that improved balance sheet footing that you mentioned at the beginning.
Indeed, and it could also reflect maybe much better levels of resilience than we've thought, because if you think of all the successive shocks UK and advanced economy businesses have gone through in the past 10 years, there have been quite a lot of them.
Yeah. Well, one aspect of that, we touched upon it last time, but I think it's really important, is that this sequence of nasties has generated a degree of muscle memory within businesses about how to be agile, how to adapt to these shocks to the system. It's not just building up bigger buffers, although that's important. It's also the ability and willingness to act at pace if circumstances change. Look at the way in which global supply chains have adapted last year to tariffs and this year to the shutting of the Straits of Hormuz. That's reflecting, built-in behaviours that actually are helping protect and flex the economy in the face of this sequence of shocks.
I mean, one of the other areas of interest for me is whether there are any nonlinear effects that we're not observing, i.e. if the situation does get worse, does that resilience give way to a bit more of adaptation, but actually a bit more cost? But hopefully we won't get there in terms of the risks.
No, but the risk is definitely there. And I mean, to be honest, if you told me that here we are, more than 2 months in to the Straits of Hormuz having been closed, with at best a big open question about whether they will open anytime soon, and even when any opening comes, will it be a full opening or a graduated opening? If you'd said that would come to pass, and yet stocks will still be at all-time highs, that would not be a bet I'd have taken at the time, Barret. That still perplexes me a bit. And I do wonder whether there might be a bit of irrational exuberance in the pricing of some securities. I mean, last year was very much concentrated in the US and in the Magnificent Seven. This year looks a little bit more broadly based, if anything. That begs at least a question in my mind about whether the markets are getting this precisely right.
So watch that space, I would say.
Space.
I mean, we touched upon private sector balance sheets. I think what's also quite interesting is the public sector balance sheets, and in particular the cost of borrowing, which for the UK is sort of, for long-term debt is now north of 5% consistently.
10 years, that's right.
Exactly, and which then begs the question, where is the nominal growth going to come from? Because if you don't, do you have a perspective on that?
Well, it has been striking, hasn't it? I mean, often financial markets are light on a particular measure or metric, and for much of this year, it's been oil prices. They have been the searchlight has been firmly on those as an arbiter of the fortunes of the world economy. I think over the course of the last week or so, week to 10 days, at least in the UK, government bond yields have probably attracted at least as much attention as global oil prices.
True.
As 10-year government borrowing costs have gone north of 5%. And at the 30-year horizon, bond yields are now close to 6% than they are to 5%, which is striking and will, of course, impart some drag on the economy.
Mm-hmm.
It will shrink the amount of headroom that the Chancellor has against her fiscal rules, and therefore make for a more difficult situation. There isn't, I think, any one reason for that. It's been some combination of Iranian events raising the likely level of inflation. And since we've last spoken, my former employees at the Bank of England have published their latest monetary policy report with 3 scenarios, perhaps rather like the 3 scenarios we'll come on to, one of which has inflation picking up to as high as 6% in an escalation scenario. So some of that risk has been to be priced in government bond yields. There's probably also, though, as we approach the local elections in the UK, which take place tomorrow, that might be the cue for a further round of political uncertainty, which in some ways may be mirrored in fiscal policy uncertainty, and that some of that has been priced in yields as well. What is significant here, I think, Barrett, is that all global bond yields have sold off, but UK bond yields have sold off proportionately more, given its greater inflation sensitivity and perhaps also its greater political uncertainty, neither of which are a good thing for growth or for the government's fiscal position.
So what I'm hearing there is both global and local factors.
Both global and local, but the notable feature is how fat the premium of UK borrowing costs over the G7. You know, if you compare with Germany, for example, I think there's more than 200 basis points difference in yields now, longer-term yields, which is quite stark when it comes to growth prospects. And let's be clear, German growth's hardly tearing away, is it?
Yeah, okay. Shall we switch our topic to Iran, because it is still ongoing, and it is a theme and an area where increasingly our clients are asking more and more questions about impacts, business implications, how they can mitigate some of the effects. I suppose for me, the starting point is that at times of uncertainty, you have to think of different alternatives of what the future could look like. And us economists, we like our scenarios. And maybe I should speak a bit about some of the scenario analysis we've done.
Yeah, please. It sounds fascinating work and really important. You know, I think this is, with the world as uncertain as it is, I think casting this as scenarios rather than some sort of probability distribution is just the way to go. And that's the way, as I mentioned, the Bank of England has gone. And it's great that you're doing some work internally in a similar sort of spirit.
And what we thought about when we were thinking about scenarios, we had 3 scenarios in mind. One of them a gradual easing one, and I suspect the description is quite apt in that it is a scenario whereby within weeks we get a resolution of what is happening in Iran. And ultimately, I think the main channel of transmission is the fact that flow rates from the Strait of Hormuz pick up and they return to pre-war levels by the end of the calendar year. And then on the other extreme, we have a escalation scenario whereby there is no resolution or return of the flow rates in the Strait of Hormuz, and that has knock-on implications to the global economy. And then the middle scenario is one whereby the flow rates return, but they don't they return to pre-war levels in around mid-2027. And the approach we followed to model this out, as economists we do like our models, was to consider the 3 channels of transmission. First one being energy, And I think quite a lot of the scenarios I've seen out there tend to focus sometimes just on energy.
Right. Yeah.
And one of the other novel sort of methods we've used within that energy segment is we've sort of accounted for physical prices of oil rather than the financial prices, because as some of our audience members might have noticed, there is a wedge now developing between those two prices, which is appearing to be more persistent than many people have thought. So that's the energy channel. The second one is the downstream effect. So, high oil prices or a reduction in oil flows and natural gas has meant that, you feel knock-on impacts on a variety of downstream industries, ranging from urea, which is important for fertilizer, aluminium, and so on and so forth. So we've taken that into account as well. And then the third point is the risk aversion and the risk premium that results in financial markets. It's really interesting how this sort of pans out in terms of economic impact. I think in terms of the high level, the worse the scenario in terms of the inputs, the bigger the impact on global growth. And that's because most of the global economy is net energy importing, which then means that has a cost. And if we focus just on the G20 economies, there's interesting patterns appearing. So I think Asia, ex-China, seems to be quite exposed. And that's because their current supply chains, particularly for energy, is basically contingent on the Gulf. Europe and the UK paid themselves a bit through it in the lighter scenarios. So they go into the pockets and they fork out a bit more cash and adapt a bit on the margins. And then some of the other natural resource-rich economies, like the United States, like Russia, and maybe some of the Latin American countries, the impact is a bit more muted. Now, you do see, however, what's quite interesting, some of these non-linear effects creeping in, the more severe the shortage is, and the more persistent it becomes as well. And it does pose a really interesting question, I think, for businesses, because for me, across all of these scenarios, businesses need to adapt. You cannot ignore what's happening in the Middle East. We're already getting quite a lot of questions from a variety of sectors, actually, about what it is that they should do, what best practice looks like, what others are doing. I think in the more severe scenario, whereby we sort of project a quite low 2026 global growth numbers to the tune of about 1.5, 1.6 in PPP terms, I think that's the scenario where both business and governments really have to accelerate and take long-term decisions in the short term. And it's going to be quite interesting if that scenario manifests, because it does mean that, unlike in the past, countries might have to make big decisions about trade policy, industrial policy, their energy systems, potentially, alliances, and so on and so forth. And I don't think there's a predetermined path. Countries will be guided by national interests. There will not be a central coordinating body that does all of this, which then means if you're a multinational, all of a sudden, and you're active in 10 countries, all of a sudden you need to be aware of what's happening in your individual sort of nation states. But I suppose the key message coming out from the economic scenario analysis is that there are massive business implications to consider in each and every scenario. So that's sort of a nutshell of some of the highlights that we found.
Sounds like important work, Barrett, and very useful, one for sort of quantifying the scale of scenarios that are possible, but also as a matter of business planning. We should obviously hope for the best and hope we avoid that escalation scenario, but hope isn't a strategy. We need to be planning for the worst. And from what you say, from your scenarios, the worst can be really quite bad. You mentioned in there the importance of non-linear effects. I think that is a really important point when we're into those, if not worst case, then worst case scenarios. because I think there's a sort of fundamentally important difference between scenarios where price rises, and that is painful for business, but it can still get whatever it needs by way of raw materials, albeit at an escalated price. The difference between that and the matchy not being able to get their hands on whatever it is at any price. They are, if you like, rationed by quantity rather than by price. The second of those is plainly much more disruptive to your business model, your viability and ability to function. And it sounds like in some of your worst case scenarios, you may well be into ones in which there isn't enough of the raw material to actually go around to meet the needs of the population and of businesses and their supply chain needs. That would be one significant non-linearity. I mean, another, I think, would be, you mentioned your sort of third bucket of factors was ones around risk appetite and sentiment. And we know from crises past, the big swing factor is often confidence and sentiment.
That's true, yeah.
I think as soon as you are into a world of quantity rather than price rationing, those sentiment effects on households and on businesses will really kick in. You know, the day in which there isn't enough jet fuel for us to go on holiday, it's going to have a pretty non-linear effect on my behaviour, and I suspect on yours as well, indeed everyone across the UK. So, you know, I wouldn't want to talk us into recession or depression, far from it, but that makes clear for me that those tail risks do exist. They could be significant, that we should hope for the best, but probably plan
for the worst.
For the worst.
And one final point, maybe I should finish off with an anecdote. I was speaking to an Australian colleague of mine just before we were recording this podcast, and she raised a really apt point, I thought, which was, you know, this isn't the 70s in that our economies are less oil intensive as they had been in the past, which is a good point. However, she said, in the sectors where we do use oil, which are energy intensive, we don't have substitutes. So we really specialize in those by getting energy, and we're in a predefined way.
Yeah.
So she did say, you know, the opportunity to substitute, whilst it sounds theoretically nice, in practice it's quite difficult.
Yeah, I think there is something to that. That if you look into the sectors that are particularly energy heavy in their usage, agriculture being a case in point, we can't survive without food and drink. Parts of manufacturing will be a second. We need physical machinery and plants to make the world go round. Technology will be a third, very heavy energy user. And we're significantly more dependent on technology and digital to make our systems work these days than we were in the 70s. So I think there's some truth in that. If you look beneath the headline to the sectoral energy dependencies, that may give you a further cause for some concern when you look at how the distribution falls.
Thank you for that, Andy. I think the key takeaway for me is that I need to book my summer holiday from now.
Sooner rather than later.
And thank you everyone for listening in. We will be coming back in about a month's time again to talk about some of the questions that our clients are asking us. Thank you.